MSCI stock analysis. What do billion-dollar hedge funds, ESG, and your average index ETF all have in common? They almost all rely on one quiet, insanely profitable company. It doesn't build skyscrapers, it doesn't mine gold, but it makes billions by ranking, rating, and ruling over those who do. Welcome to the world of MSCI Inc., a mysterious force in the global finance with ties to some of the most powerful institutions in Wall Street. With a return around 750% in the last 10 years, this company doesn't just make money, it multiplies it. Overview. MSCI started as a piece of Morgan Stanley in the 90s, but has since become the brain behind trillions of dollars. It provides critical tools like indexes used by BlackRock, Vanguard, and every major ETF issuer, ESG ratings that can move markets, risk analytics trusted by the top hedge funds, also real estate and private asset analytics used by institutional investors globally. Think of MSCI as the picks and shovels for modern investing. It doesn't bet on the market, it sells the blueprint to those who do. And here's what makes the business so powerful. The majority of MSCI's revenue comes from recurring subscriptions. That means investors, asset managers, and institutions pay again and again, year after year, for access to its data, models, and tools. Most revenue comes from indexes, analytics, and ESG. It's a dream business model, predictable, high margin, and extremely sticky. Financials. Let's take a look how MSCI is doing financially. The company's forward EPS is around $16.79, with a forward PE ratio of around 32. It pays a healthy dividend of $7.2 per year, which equates to a forward yield around 1.3%. This is backed by a strong recurring free cash flow. MSCI's dividend has grown at an impressive 20% annual rate, with that momentum continuing for over a decade. In terms of performance, MSCI has quietly outperformed over the long term, becoming a compounder that delivered solid double-digit returns year after year. 1-year returns around 12%, 5-year returns around 70%, and 10-year returns around 750%. Revenue per share has been climbing for over a decade. Total revenues continue to grow steadily. Same story with EPS growth for a decade straight. But one of the most impressive numbers here is MSCI's return on invested capital, which is 32%. That's elite, putting them among the best capital allocators in the entire market. It means they're earning massive returns every time they reinvest into their own business. Returns on equity also very high, 25%, which reflects strong profitability without excess leverage. In short, MSCI is a high-margin, capital-efficient business with sticky revenue, growing cash flows, and pricing power built on data and reputation. It doesn't need a flashy dividend when every dollar reinvested earns over 30% in return. But still, they give out around 40% of their EPS in dividends. Future. So what's ahead for MSCI? Let's start with the opportunities. The rise of ESG investing and global regulation is pushing more money into products MSCI controls. Passive investing keeps growing, and guess who runs the indexes? Private assets and real estate data is still under-penetrated, but MSCI is expanding fast. Risks. First, ESG has become politically polarized. If the trend fades and regulators push for transparency beyond third-party scores, MSCI's influence and revenue could take a hit. Second, competition is heating up. Firms like S&P Global, Morningstar, and FTSE Russell are fighting for market share in the indexing, analytics, and ESG. And third, MSCI has some revenue concentration risk. Its largest client, BlackRock, accounts for roughly 10% of their total revenue, mostly through ETF licensing fees tied to MSCI indexes. If BlackRock ever decides to shift more assets to a different index provider or build in-house, MSCI would feel the impact. Still, the company's business model is incredibly sticky. Index providers don't get swapped out easily, especially when trillions are tied to the benchmarks. Intrinsic value. Let's try to estimate a buying price for MSCI. EPS is around $16.79, and analysts are estimating it to grow around low double digits. MSCI is a quality company, so I would expect analyst expectations be entirely possible. So I will presume a 10% growth for the next 5 years and 7% after that for the next 5 years. At a forward PE ratio of around 33, MSCI isn't cheap, but it rarely is. Median PE ratio for MSCI is around 38, and in the last 10 years the multiplier has come down. With this in mind, I want to be conservative with my multiplier estimate. I would expect it to trade at least 28 in the next decade. And as always, I want 12% for my money. With these numbers, we can calculate a buying price of around $490, with MSCI stock price trading around $550 now. It seems a bit overpriced. This is mainly due to my multiplier estimation being way lower than median and the current PE ratio. This being said, MSCI is the kind of business that gets better over time. Its margins have been expanding, its pricing power increases, and its customers stay loyal. If you're a long-term investor, this might be the kind of stock you wait for to buy, then hold forever. It's not a flashy AI stock, but it's a quiet compounder that the smartest investors never ignore. And whether the ESG survives or not, whether the markets crash or climb, MSCI will be there, ranking, rating, and quietly collecting billions. With these things in mind, I still don't own MSCI yet. I really like the company, but I feel like I can get a little bit better price. And as always, this is not financial advice. Do your own research. If you enjoyed this breakdown, hit the like, subscribe, and let me know in the comments what stock should we analyze next. Is my analysis way off? Do you own MSCI? And as always, do not lose money and safe travels. Bye bye.